because we had a big week in gold stocks, and I think it's a very significant week. And I really want to make sure that my podcast audience is invested in this sector to the extent that they, are, risk seeking. These are not for widows and orphans because there is risk. Although I believe the upside potential dwarfs the downside risk. And I think that, when you get a situation where it's so asymmetric, where you have so much profit potential relative to what you can lose, that's when you want to make a big bet. I mean, I think that's how people have made a lot of money in the markets over the years, is by waiting for these asymmetric opportunities and then going all in. And I think that is something you'd want to do with the gold stocks. Now, last week, gold didn't really move very much. Gold was only up about 1.3%. Now, that's in the spot market. There was some extra action in the futures market. Gold futures, the front month, I think, or December gold even, hit new all-time record highs. We didn't see record highs in the spot market. And the reason for that was that Donald Trump threw a monkey wrench into the gold market because there were stories that came out that 100-ounce and kilo gold bars would actually be subject to tariffs. And a lot of those bars are fabricated in Switzerland. And Switzerland is subject to a 39% tariff. At least Americans are subject to that tariff if they import something from Switzerland. Well, if you import gold bars from Switzerland, 39%, that is a huge premium. And so what happened was, I think some of the shorts in the futures market needed to cover. They needed to buy back their contract, because when you are short a contract, you are obligated to deliver the underlying metal if the long decides to put in a notice that he wants delivery. Now, of course, most of the gold that trades on the COMEX is never delivered, so it's not a big deal. But anybody who is long one gold contract could take delivery of a 100-ounce bar. And that means that whoever is short could get assigned that delivery. And it means that the short, if they haven't closed out their position, now has to buy a 100-ounce bar and deliver it. Well, if you have to import that bar, you have to pay the tariff. You can't charge the tariff to the long because he's got his price locked in. As a short, you are obligated to deliver gold at whatever price the long owns. He just has to pay the price that he paid when he bought the contract. And the short has to deliver the gold at the price he sold the contract, but now he's got to pay a tariff. And even if he wasn't going to have to import the bar from Switzerland, you would figure that all 100-ounce bars or kilo bars would start to move up in price because it was so much more expensive to bring them into the country. So I think in the futures market, you got a lot of short covering, which is what spiked the price to record highs without seeing that in the spot market. Now, I believe the spot market would have followed and made new highs probably this week, although it could do it. I mean, gold closed around 3,400. It's never hit 3,500. I forget what the record high was, maybe 3,450-ish or something like that. But what happened after the markets closed on Friday is the Trump administration backtracked, although they said it was all misinformation and that Donald Trump is going to be issuing an executive order that clarifies the fact that these gold bars are not going to be subject to the tariffs. But, I don't really think it was misinformation. It might have been a trial balloon that didn't go well. And maybe, after Trump was presented with some facts that he didn't like, he changed his mind and decided to say the whole thing was misinformation. But I doubt the stories would have run had the government not put out that information. They just didn't like the way the markets received the information. So they did an about face, which is something that is pretty typical of the Trump administration. I just wish they would do an about face on more things. I'm going to get into that in a bit, but the Trump administration is doing a lot of things that I think are wrong. and unconstitutional and bad economics and should not be done. But let me get back to what's happening in the gold market. Or the gold stock market. So gold was up 1.3%. I mean, not a huge week. Silver was up more. It was up about 4%. But that's because silver was down 3% the prior week. So silver just kind of bounced back, recovered ground that it shouldn't have lost. But the real action was in the mining stocks. The GDX, which is an index of gold stocks, the GDX was up 10.7% on the week. That is a big move. The GDXJ, which is the juniors, was up 11%. And in fact, it took until Friday, I think, for the GDXJ to make a new, 52-week high or a new high since, I don't know, 10 years, 12 years, whatever. But the GDX made a new high for this particular bull market, I think Monday or Tuesday. It took a while for the smaller stocks to catch up and eventually make new highs on Friday. But I think the fact that you're finally starting to see significant strength in the gold and silver mining companies, even without a lot of strength in gold. Gold did not have a big week, but the mining stocks had a huge week. And so I think this is really a sign that institutional money is finally waking up to what's going on here and allocating money into this sector. And we got a long way to go. I mean, these stocks are still substantially below their highs from 2011 when gold was at 1900. So, I mean, gold has moved up 80% since then. And, a lot of these stocks are, quite a bit lower now than they were then. And the valuations are ridiculously low. If you look at these stocks on a price to earnings ratio and a lot of other metrics that historically you use to value these stocks, and these stocks are at historically low valuations. And so I think this is not going to be lost on investors for long. You're going to see more and more money flowing into these stocks. And I think the returns are just going to get better over the years. Now, the GDX is up now after this 10% move. It is up 71% so far this year. Of course, the year's not even over yet. And you got a 71% gain, right? Investors, institutional investors, are going to notice this. They're going to start putting gold stocks on their screens, I think, for the first time. For all the hoopla around Bitcoin, right? Because Bitcoin's stole all the spotlight from gold this year, right? Everybody, Bitcoin, right? With the Trump making America the Bitcoin capital of the world. Meanwhile, he's adorning the entire Oval Office in gold. I mean, I saw some images of the Oval Office now, and there's just gold all over the place. In fact, I saw that Apple, Tim Cook came to the White House and presented Donald Trump with like a token of his appreciation, a plaque, a glass plaque. But the case, right, or the base of the plaque, he said was 24 karat gold. Now, if it's solid 24 karat gold, that's $1 million base. That's a great gift for the president, kind of, more like a bribe, because he was giving out some exemptions on tariffs on semiconductor imports. But Bitcoin has been getting all the attention. Well, Bitcoin is up on the year, but 24%. I mean, that's still a big move, although Bitcoin can crash, at any moment. But it's up 24%. But if you bought gold is up 29% on the year. So gold year to date in the year of Bitcoin, right, gold is beating Bitcoin. And, with all this buying, and, a lot of the buying now is coming from these Bitcoin treasury companies. Now they even got Ethereum treasury companies, but it's all Wall Street piling into Bitcoin, yet it's not even doing as well as gold, but it's doing a lot less than the gold mining stocks. because you would think, hey, let me leverage a bet on gold. Maybe somebody thought that Bitcoin was a way to leverage gold, that they thought it was, supercharged gold, gold 2.0. Well, it underperformed gold. What outperformed gold were gold stocks at 71%. Gold stocks even outperform MicroStrategy, which MicroStrategy stock or strategy, they dropped the micro, although pretty soon it's just going to be micro because the stock's going to collapse. But year to date, it's up 38%, although the main reason for that is that it got clobbered in December. From the end of November, it's basically flat. But year to date, just for apples to apples, MicroStrategy is up 38%. You've done a lot better buying the GDX, gold stocks. And I think this is going to continue. And I think that a lot of people who took some of their gold chips and moved them over into the Bitcoin space, they're gonna move them back. They're gonna realize that they're better off with real gold rather than this digital alternative, fool's gold. And that money is going to come back to the gold market. I don't even think it's started yet. I just think you have some new money coming into the space, but the money that left it hasn't come back yet. I have a gold fund, right, that Adrian Day manages it for me, the Europe Pacific Gold Fund. And my gold fund is only up 60% on the year. Now, I say only, that's still a great return for a little over half a year, but it's not as good as the 71% in the GDX. And people might say, well, Peter, why should we buy your fund, right? Why should I pay the management fees if you're underperforming an index? Well, it's because we're underperforming the index now that I think we're going to so outperform it over the next several years. Because the reason that we only have a 60% return year to date is because we have a significant percentage of the portfolio in a lot of very small junior mining companies. And these companies haven't attracted the institutional money yet. The money that's going into the sector is going into the big stocks first. Now, we own a lot of those stocks too, but we also have this allocation to these junior stocks that right now are dragging the portfolio. But in the long run, they're going to lead the portfolio because the next phase, right, the next movement is going to be into these smaller stocks. Now, you might think, well, why not wait until they start to move and then buy them? Well, there won't be any liquidity. It took Adrian years, many, many years of buying to get these stocks. It's not easy to buy size for these small companies. In fact, a lot of the positions we have were accumulated through private placements where these companies were raising money and they were selling stock. And so we would just buy it into the fund. Also, the fund owns warrants on a lot of these companies that are out of the money now and so don't really show up much in the NAV of the fund. But when these stocks really start to move, assets that really have very little to no value can be very valuable. So I think we have some huge future performances baked in right now because of all of these small stocks that Adrian was able to accumulate for us during the bear market. These small cap companies had a hell of a hard time raising money. And so they had to, dilute the stocks. Nobody's been paying attention. But I think they're going to be some of the biggest winners. And Adrian is really good at knowing which small companies to buy and which ones to avoid, right? Because there's a lot of opportunities to lose money in the junior mining space. And the key to being successful is to try to avoid, the landmines and buy the gold mines. And I think Adrian's done a great job of doing that. And so I think this is a great time. People really should be loading up on my gold fund, EPGIX. That is the symbol for the no load version. You could buy this gold fund anywhere on any of the major discount brokerage firms. And look, if you don't want to buy my gold fund, if you just want to buy the index, you'll make money, I think. I think it's going to be hard not to make money in the gold sector, right? I think this could be a huge historic bull market. So I think you make money pretty much no matter what you do. But I think you'll make more money in my fund, because I think Adrian has done an excellent job of building this portfolio. And people can still take advantage of this portfolio by buying my fund now, because by buying my fund, we don't necessarily buy more of these companies. We already own big positions in these companies. And so it's not going to push the price up. But eventually, when more money goes directly into these little stocks, there's not going to be a lot of selling. And so the buyers are going to overwhelm the sellers. And I think you're going to see these little stocks moving up much more than the bigger stocks. It's just that the bigger stocks are moving first. And so that's why you're seeing that in the indexes, because those are the stocks that dominate. Even the GDXJ, which is supposed to be junior miners, even those companies are pretty big. You know, they're not necessarily juniors in the true sense of the word. There's a lot of larger companies that are still included in the GDXJ.